Welcome back to The Sleepy Scientist, where we explore big questions with a gentle voice and an open mind. Tonight, we're diving into something that might sound like science fiction, but is closer to reality than you might think. What if artificial intelligence took control of our money? Not just helped us manage it, not just provided suggestions, but actually took control. Every transaction, every investment, every economic decision, guided by algorithms and neural networks instead of human hands. Before we drift into this fascinating and slightly unsettling exploration, I'd love to know where you're watching from tonight and what time it is in your corner of the world. Are you tucked into bed in Tokyo at midnight or curled up on a couch in Toronto at sunset? Let me know in the comments. It's always wonderful to see how this community spans the globe, each of you arriving at this moment from your own unique place and time. If you find these thoughtful explorations soothing or intriguing, I'd be grateful if you tapped the like button and subscribed. It helps this sleepy little channel reach others who might need a peaceful pause in their day. And as always, I hope this isn't so interesting that it keeps you awake, but if it does, well, at least you'll have learned something fascinating about the future of money before you finally drift off. Now, settle in. Get comfortable. Let's begin our gentle journey into a world where silicon minds manage our wealth, make our investments, and perhaps reshape the entire global economy. Here's a statistic that might surprise you. Right now, today, as you listen to this, artificial intelligence is already involved in approximately 70% of all stock market trades in the United States. 70%. High-frequency trading algorithms execute millions of transactions per second, far faster than any human could ever hope to match. These systems analyze market patterns, predict trends, and make split-second decisions that move billions of dollars around the globe. And that's just the stock market. In banking, AI systems process loan applications, detect fraudulent transactions, and assess credit risk. Digital assistants help us track our spending, suggest budget adjustments, and remind us when bills are due. Robo-advisors manage investment portfolios for millions of people, rebalancing assets and optimizing returns without human intervention. Cryptocurrency exchanges run on automated protocols that require no central authority. Payment processors use machine learning to approve or decline transactions in milliseconds. The truth is, artificial intelligence doesn't need to take control of our money in some dramatic, overnight revolution. It's already happening, slowly, steadily, one algorithm at a time. We're building the infrastructure, writing the code, and handing over the keys to systems that, in many ways, already understand our financial lives better than we do ourselves. But what if this gradual integration accelerated? What if we woke up one day to find that AI hadn't just assisted with financial decisions, but had become the primary decision maker? What if the algorithms didn't just suggest, but controlled? What would that world look like? What would change? And perhaps most importantly, should we be excited or terrified? These aren't idle questions. The trajectory we're on suggests that increasingly sophisticated AI systems will play larger and larger roles in managing global finance. Some futurists predict that within the next few decades, most financial decisions, from personal budgeting to international monetary policy, could be guided or even controlled by artificial intelligence. The technology is advancing rapidly. The infrastructure is being built. The question isn't really if this will happen, but when and to what degree. Tonight, we're going to explore this possible future together. We'll examine how AI could take control of our money, what benefits that might bring, what dangers it could pose, and what it all means for us as individuals and as a society. We'll think through scenarios both optimistic and troubling. We'll consider the ethical dilemmas that arise when we hand financial power to systems that don't think like we do, don't feel what we feel, and don't share our human values unless we explicitly program them to. This isn't a simple story with a clear hero or villain. Artificial intelligence isn't inherently good or evil. It's a tool, though an incredibly powerful one, shaped by human choices, human biases, and human intentions. The future of AI-controlled finance will be determined not by the technology itself, but by how we choose to develop it, deploy it, and regulate it, by the values we embed in the code, the safeguards we build into the systems, and the oversight we maintain even as we delegate more and more decisions to machines. So let's begin this journey with open minds and gentle curiosity. Let's explore a world where AI manages the flow of money through our lives and across the planet. A world that might be more efficient, more stable, and more prosperous than anything we've known. Or a world that could be more unequal, more vulnerable, and more alien than we ever imagined. Or perhaps, most likely, a complex mixture of both. Take a deep breath, settle deeper into your pillows, and let's imagine together what happens when artificial intelligence takes control of our money. The dawn of financial AI. Where we are now. To understand where we might be going, we first need to understand where we are. Artificial intelligence isn't waiting in the wings, preparing for some grand entrance into the financial world. It's already here, woven into the fabric of modern finance in ways both visible and invisible. Every time you check your bank balance on your phone, there's AI working in the background. Every time you swipe your credit card, algorithms are analyzing that transaction. The financial system you interact with every day is already partially automated, already partially controlled by machines. Let's start with the most visible application: personal finance apps and digital assistants. Millions of people around the world use applications like Mint, YNAB, or built-in banking apps that categorize spending, track budgets, and provide financial insights. These systems use machine learning to recognize patterns in your spending, predict future expenses, and offer suggestions for saving money. Some can even automate certain financial tasks, like transferring money to savings accounts when you receive income or scheduling bill payments. These tools are helpful, certainly. They make financial management easier and more accessible, especially for people who might not have the time, knowledge, or inclination to meticulously track every dollar. But they're also the beginning of something larger. They represent our growing willingness to let algorithms see our financial lives in intimate detail and to trust their recommendations. We're becoming comfortable with AI as a financial advisor, even if we don't always think of it in those terms. Then there are robo-advisors, investment platforms that use algorithms to build and manage portfolios. Companies like Betterment, Wealthfront, and even traditional institutions like Vanguard offer automated investment services that ask you a few questions about your goals and risk tolerance, then construct a diversified portfolio tailored to your needs. These systems rebalance your investments automatically, harvest tax losses, and adjust your allocation as you age or as market conditions change, all without a human financial advisor ever picking up the phone. The appeal is obvious. Robo-advisors charge much lower fees than human advisors. They're available 24 hours a day, and they make decisions based on data and algorithms rather than gut feelings or emotional reactions. For many people, especially younger investors, or those with modest savings, robo-advisors have made investing accessible in ways it never was before. You don't need $50,000 and a meeting with a wealth manager. You can start with $50 and an app. But here's what's interesting. These systems aren't just following simple rules. Modern robo-advisors use sophisticated machine learning models that analyze vast amounts of market data, economic indicators, and historical patterns. They can identify correlations and opportunities that human advisors might miss. They can process information from thousands of sources simultaneously. And they're constantly learning, constantly refining their models based on new data and new outcomes. Moving up the scale, we enter the world of institutional finance, where AI's presence is even more pervasive and powerful. High-frequency trading, or HFT, is perhaps the most dramatic example. These are algorithms that execute trades in microseconds, millions of times per day, exploiting tiny price differences that exist for fractions of a second. No human trader could possibly compete. The algorithms can read market data, make decisions, and execute trades faster than a human could even blink. HFT firms use AI to predict market movements based on patterns in trading data, news feeds, social media sentiment, and countless other variables. Some systems use natural language processing to read and analyze news articles and corporate reports in real time, adjusting trading strategies instantly based on new information. Others use computer vision to analyze charts and technical indicators at superhuman speeds. The result is that much of the trading that happens on major stock exchanges today is machine-to-machine, algorithm versus algorithm, with humans largely removed from the loop. This has transformed financial markets in profound ways. Liquidity has increased dramatically, as there's always an algorithm willing to take the other side of a trade. Spreads have narrowed, making trading cheaper for everyone. But it's also created new risks. Flash crashes, where markets plunge and recover in minutes, have become more common. These crashes are often triggered or accelerated by algorithms reacting to each other in cascading loops, creating volatility that has nothing to do with underlying economic fundamentals and everything to do with how the machines are programmed to respond to unusual conditions. Banks and financial institutions use AI extensively for risk management, fraud detection, and customer service. Machine learning models analyze transaction patterns to identify potentially fraudulent activity, flagging suspicious charges before they're even completed. Credit scoring systems use algorithms to assess loan applications, weighing hundreds of variables to predict the likelihood of repayment. Customer service chatbots handle routine inquiries, freeing human representatives to deal with more complex issues. These applications have made banking more efficient and, in many ways, more secure. Fraud detection systems catch billions of dollars in fraudulent transactions every year. Credit models can assess risk more accurately than traditional methods, potentially expanding access to credit for people who might have been denied under older systems. Chatbots provide instant assistance at any hour in multiple languages without long wait times. But they've also raised questions. Credit algorithms, for instance, have been found to perpetuate or even amplify existing biases. If the historical data used to train these models reflects past discrimination, the AI will learn and replicate those patterns, denying loans to qualified applicants or charging higher interest rates based on factors that correlate with race, gender, or socioeconomic status, even if those factors aren't explicitly programmed into the system. The algorithm doesn't intend to discriminate, but it can learn to do so anyway if we're not careful about the data we feed it and the outcomes we optimize for. Some philosophers and AI researchers argue that we shouldn't be delegating these kinds of morally weighty decisions to AI at all, that there are some decisions that ought to require human judgment, regardless of whether AI could technically make them. They propose a principle: meaningful human control. The idea is that for decisions with significant moral dimensions or serious impacts on human welfare, there should always be a human in the loop with genuine authority to understand, evaluate, and override the AI's recommendations. This principle makes intuitive sense, but it's harder to implement than it might appear. What counts as significant impact? Who gets to be the human in the loop, and what qualifications should they have? How do we ensure their oversight is meaningful when they're reviewing thousands of AI decisions, when the AI's reasoning is too complex to fully understand, and when the human becomes psychologically dependent on simply approving what the AI recommends? We're left, then, with a profound ethical dilemma. AI systems could help us make better financial decisions in many ways, more accurate, more consistent, less biased by emotion or prejudice. But those same systems lack moral understanding, can't exercise meaningful moral judgment, and consolidate moral authority in the hands of whoever programs them. They create risks of embedding biased values, of making decisions without understanding their human impact, of operating according to moral frameworks that weren't democratically chosen and can't be easily challenged or changed. The path forward, if there is one, probably involves explicit moral deliberation about what values we want AI systems to embody, robust democratic processes for making those decisions, strong transparency requirements so people can understand and challenge AI moral judgments, and clear limits on which decisions AI should make autonomously versus which require human moral judgment. But these are conversations we're only beginning to have. We're building and deploying these systems faster than we're resolving the ethical questions they raise. And that means we may face moral crises, situations where AI-controlled financial systems make decisions that large numbers of people find morally unacceptable, before we've developed the frameworks and safeguards to prevent such outcomes. The cost of that learning process, paid in human welfare and social conflict, could be considerable. If the technological and ethical challenges of AI-controlled finance weren't daunting enough, we also face profound difficulties in regulation and governance. How do we create rules for systems we don't fully understand? How do we regulate technology that evolves faster than the regulatory process? How do we achieve international cooperation when different nations have competing interests? These aren't just administrative questions. They're fundamental challenges that will shape whether AI-controlled finance serves humanity well or becomes a source of instability, inequality, and harm. Let's begin with the most basic problem, the knowledge gap. Effective regulation requires regulators who understand what they're regulating. But AI, especially advanced machine learning systems, is extraordinarily complex. Even the experts who build these systems don't always fully understand how they work, particularly deep neural networks that learn patterns from data in ways that can't easily be traced or explained. Regulators, meanwhile, are typically not AI specialists. They're lawyers, economists, policy experts, people with deep knowledge of finance, but not necessarily of artificial intelligence. The pace of AI development is also much faster than regulatory cycles. By the time regulators understand a technology well enough to write rules for it, the technology has often already evolved into something new. This creates an asymmetry between those being regulated and those doing the regulating. Financial institutions employing cutting-edge AI have access to the best AI talent, the most advanced technology, and the deepest understanding of how their systems work. They can run circles around regulators who are trying to keep up with less resources, less expertise, and slower decision-making processes. And that asymmetry makes it very difficult to write and enforce effective rules. One approach to addressing this is to require transparency and explainability. If financial institutions must explain how their AI systems work, what data they use, how they make decisions, then regulators have a better chance of understanding and overseeing them. Some jurisdictions have already implemented such requirements. The European Union's GDPR, for instance, includes provisions for a right to explanation for automated decisions, but transparency requirements create their own challenges. First, there's the trade secret problem. AI systems, especially successful ones, represent significant intellectual property and competitive advantage. Companies are understandably reluctant to reveal details that could benefit competitors. They'll argue that requiring full transparency would undermine innovation and harm their business interests. Second, there's the complexity problem we've already discussed. Even with full access to an AI system's code and training data, understanding how it actually makes decisions can be extraordinarily difficult. Deep learning models can have millions or billions of parameters. Explaining why a particular decision was made might require sifting through complex interactions among thousands of variables. Even if the company provides all the information, regulators might lack the expertise or resources to make sense of it. Third, there's the dynamic nature of AI. Many modern AI systems continue learning and adapting after deployment. A system that regulators approved based on its initial behavior might evolve over time into something quite different. How do you regulate something that changes continuously? Do you require reapproval every time the system learns something new? That would be impractical for systems that update constantly. Another regulatory approach is to focus on outcomes rather than methods. Instead of trying to understand how AI systems work internally, regulators could simply monitor what they do, test whether they produce discriminatory results, measure whether they create systemic risks, and enforce penalties when problems occur. This outcome-based regulation sidesteps the need to understand AI's inner workings, focusing instead on whether the systems produce acceptable results. This approach has appeal, but it also has limitations. First, bad outcomes might not be apparent until significant harm has occurred. If an AI system gradually develops problematic biases or creates hidden vulnerabilities in the financial system, outcome-based monitoring might not catch these problems until they manifest in a crisis. By then, the damage is done. Second, outcome-based regulation might struggle with edge cases and rare events. An AI system might perform well in normal conditions, but fail catastrophically in unusual situations. If regulators only test or monitor during normal times, they might not discover these vulnerabilities until it's too late. But comprehensively testing for all possible edge cases is extremely difficult, perhaps impossible. Third, there's the challenge of attribution. If something goes wrong in a complex financial system, with many AI components interacting, figuring out which system caused the problem can be very difficult. Was it a flaw in one AI's design? An interaction between multiple systems? A cascading failure where a small error amplified through the network? Without understanding the system's internal workings, assigning responsibility and correcting problems becomes extremely challenging. Some experts advocate for a regulatory sandbox approach, where new AI financial systems can be tested in controlled environments with limited real-world impact before being widely deployed. This allows regulators and companies to experiment, identify problems, and develop best practices without risking systemic harm. Several countries have implemented fintech sandboxes for testing new financial technologies, and this model could be extended to AI specifically. Sandboxes are promising, but they have limitations too. Problems that only emerge at scale or during crises might not show up in a limited test environment. And there's always pressure to move innovations from sandbox to full deployment quickly before problems are fully understood, because of competitive pressures and the potential benefits of new technology. Then there's the question of international coordination. Finance is global. Money flows across borders. Financial institutions operate in multiple jurisdictions. If AI-controlled financial systems are to be regulated effectively, there needs to be some level of international cooperation and harmonization. Otherwise, we end up with regulatory arbitrage, where institutions gravitate toward jurisdictions with the loosest rules, creating a race to the bottom that undermines everyone's ability to ensure safety and fairness. But achieving international regulatory coordination is notoriously difficult. Countries have different legal systems, different priorities, different levels of technological capability, and often competing interests. Negotiations move slowly, agreement is hard to reach, and enforcement across borders is even harder. We see these challenges already in areas like tax policy, money laundering prevention, and climate regulation. Adding AI governance to the mix doesn't make things easier. There's also the geopolitical dimension. AI is seen by many nations as strategically important technology, critical to economic competitiveness and national security. Countries might be reluctant to accept international rules that limit their ability to develop and deploy AI, especially if they fear falling behind rivals. China, the United States, and the European Union all have significant AI initiatives and different approaches to regulation. Getting them to agree on common standards would require navigating complex political and economic tensions. Another governance challenge involves public participation and democratic accountability. Financial regulation affects everyone, but the regulatory process is often opaque, dominated by industry insiders and technical experts, with limited meaningful input from the broader public. This is even more true for AI regulation, where the technical complexity creates barriers to participation. How do we ensure that the rules governing AI-controlled finance reflect democratic values and broad social input, rather than just the preferences of tech companies and financial institutions? How do we make these highly technical issues accessible enough that ordinary citizens can meaningfully participate in decisions about them? How do we balance expertise, which is essential for effective regulation, with democratic legitimacy, which is essential for social acceptance and trust? Some advocates propose independent AI safety and ethics boards, bodies with technical expertise but also diverse representation, charged with overseeing AI development and deployment in critical domains like finance. These boards would ideally include not just engineers and executives, but also ethicists, social scientists, community representatives, and advocates for affected populations. They'd provide a venue for broader input and a check on the tendency for AI governance to be dominated by narrow technical and commercial interests. But who appoints these boards? How do they gain authority? How do they balance competing interests and values? And how do we prevent them from either becoming captured by the industries they're supposed to oversee or becoming so restrictive that they stifle beneficial innovation? These are difficult questions without clear answers, and different societies might answer them differently based on their particular political cultures and institutions. There's also the question of liability and recourse. When AI systems cause harm, who's responsible? If an AI-controlled investment fund makes decisions that lose people's retirement savings, can those people sue? If so, who do they sue? The company that deployed the AI? The programmers who wrote it? The data providers who trained it? Is it a product liability issue, like suing a car manufacturer for defective brakes? Or something else entirely? Current legal frameworks weren't designed with AI in mind, and they don't always provide clear answers. As AI assumes more control over financial decisions, we'll need to develop new legal doctrines around AI liability, potentially including requirements for insurance, mandated reserves for potential harm, or even new forms of strict liability that hold deployers of AI systems responsible for outcomes regardless of whether they could have predicted or prevented them. Then there's the realm of digital currencies and blockchain technology, where AI plays an increasingly important role. Cryptocurrency exchanges use algorithms to match buyers and sellers, set prices, and maintain liquidity. Trading bots execute automated strategies, trying to profit from price movements across different exchanges. Some blockchain projects are exploring the integration of AI to create more sophisticated smart contracts that can adapt to changing conditions or make decisions based on external data feeds. Decentralized finance, or DeFi, takes this even further. These are financial systems built on blockchain technology that operate without traditional intermediaries like banks or brokers. Instead, smart contracts, automated programs running on blockchains, handle everything from lending and borrowing to insurance and asset trading. In a sense, DeFi is already a form of AI-controlled finance, though the intelligence is currently limited to following predetermined rules rather than learning and adapting. We should also consider the challenge of regulatory capture, where the industries being regulated come to dominate the regulatory process, shaping rules to serve their interests rather than the public good. This is already a concern in financial regulation, where revolving doors between industry and government, lobbying and technical complexity all contribute to regulators sometimes serving industry interests more than public ones. AI regulation could be even more susceptible to capture. The technology is complex, requiring deep expertise that's mostly concentrated in private companies. Those companies have enormous resources and strong incentives to shape regulation favorably. Regulators, meanwhile, are often underfunded and overstretched, struggling to keep up. Creating truly independent, well-resourced regulatory capacity for AI in finance would require significant political will and public investment, neither of which is guaranteed. Finally, there's the challenge of updating and adapting regulation as technology evolves. Whatever rules we write today will need to change as AI capabilities develop, as new risks emerge, as we learn from experience. But regulatory processes are slow. Changing rules requires navigating bureaucracy, political opposition, and stakeholder interests. By the time regulation catches up to one generation of technology, we might already be facing challenges from the next generation. Some have proposed adaptive governance frameworks that build in mechanisms for continuous learning and updating, that monitor outcomes and adjust rules accordingly, that maintain flexibility while ensuring basic safeguards. This sounds promising in principle, but implementing it in practice is difficult. How much flexibility is too much? How do we maintain stability and predictability, which are also important for functioning markets, while adapting quickly to change? How do we prevent adaptive mechanisms from being exploited or manipulated? Despite all these challenges, regulation and governance are essential. The alternative, letting AI-controlled finance develop without meaningful oversight, is likely to lead to worse outcomes. More frequent crises, more systemic risks, more algorithmic discrimination, more concentration of power, and less democratic accountability. We need rules, even if creating good ones is difficult. We need oversight, even if the systems we're overseeing are complex. We need international cooperation, even if achieving it requires navigating thorny political challenges. The question is whether we can develop effective governance fast enough, whether we can build the institutional capacity and international coordination necessary, whether we can maintain democratic accountability while leveraging necessary expertise. These aren't just technical or legal questions. They're fundamentally political questions about how we organize society, allocate authority, and make collective decisions about technologies that shape our shared future. Conclusion: balancing innovation with caution. And so we arrive at the end of our journey, having explored the landscape of AI-controlled finance from multiple angles. We've examined the benefits and the risks, the opportunities and the dangers, the technical challenges and the human consequences. We've imagined scenarios both optimistic and troubling. We've grappled with difficult questions about values, accountability, and governance. And perhaps you're wondering, after all of this, what should we actually do? Should we embrace AI control of money, resist it, or try to find some middle path? The honest answer is that there's no simple prescription. The future of AI in finance isn't predetermined. It will be shaped by thousands of decisions made by companies, governments, regulators, technologists, and citizens. By choices about how to develop AI, how to deploy it, how to govern it, and where to draw boundaries around its authority. Different choices will lead to very different futures, and recognizing that we have choices, that this isn't simply technological inevitability, is itself important. What we can say with confidence is that some level of AI involvement in finance seems nearly inevitable. The efficiency gains are too large, the competitive pressures too strong, the technological momentum too powerful. Financial institutions that refuse to use AI will likely be outcompeted by those that embrace it. Countries that over-regulate might see their financial sectors move offshore. The question isn't whether AI will play a major role in finance, but how much control it will have and under what constraints. The key insight from our exploration is that the devil is in the details. AI control of money could be beneficial or harmful depending on how it's implemented. An AI system optimized purely for profit, with no constraints on fairness or consideration of social costs, could create enormous harm, even while technically succeeding at its programmed objectives. But an AI system designed with multiple objectives, with robust safeguards, with meaningful human oversight, and with democratic accountability, could genuinely improve financial outcomes for most people. This suggests that our focus should be less on whether to allow AI in finance, and more on how to ensure AI serves human flourishing, rather than narrow metrics. That requires being intentional about the values we build into these systems, the goals we optimize for, the constraints we impose. It requires maintaining human agency and oversight even as we delegate tasks to AI. It requires building in transparency, accountability, and recourse mechanisms. And it requires addressing the social and economic impacts proactively, rather than just letting them happen and dealing with consequences afterward. One crucial principle is that automation should augment rather than replace human judgment for the most consequential decisions. AI can process data, identify patterns, and generate recommendations better than humans in many cases. But humans should retain ultimate authority over decisions with significant moral dimensions or serious impacts on people's lives. The appropriate division of labor is AI handling what it does best, processing and analysis, while humans handle what they do best, moral judgment and accountability. Another important principle is transparency. We can't maintain meaningful oversight of what we can't see or understand. Financial institutions deploying AI should be required to explain their systems to regulators and, when appropriate, to customers and the public. When AI makes decisions that significantly affect individuals, those individuals should have a right to understand why and to challenge the decision. This might require trade-offs with performance, accepting slightly less optimal AI in exchange for greater interpretability. But that's a trade-off worth making for systems that exercise significant power over people's lives. Fairness and non-discrimination must also be central priorities. AI systems should be regularly audited for bias. Training data should be carefully curated to avoid perpetuating historical inequalities. When AI decision-making produces discriminatory outcomes, those outcomes should be corrected, even if they're technically in line with the AI's programming. We need to recognize that fairness sometimes requires actively counteracting patterns in data, rather than simply optimizing blindly for accuracy. We also need robust mechanisms for democratic input into how AI-controlled finance develops. Decisions about what values to embed in AI, what trade-offs to make, what risks to accept, these shouldn't be made solely by technologists and executives. They should involve broader public deliberation, input from affected communities, and democratic accountability. This might mean citizens' assemblies on AI governance, public comment periods on major AI deployments, or even direct democratic votes on certain policy questions about AI in critical infrastructure. On the economic front, we need to address the displacement and inequality that AI automation is likely to cause. This might involve some combination of education and retraining programs, social safety nets, labor market policies, and new ways of distributing the wealth that AI generates. Universal basic income is one possibility worth exploring, but so are worker ownership models, revitalized labor organizing, and public investment in jobs that AI can't easily automate, like care work, creative endeavors, and community building. Internationally, we need cooperation and coordination, even though achieving it is difficult. At minimum, there should be common standards for AI safety in finance, information sharing about risks and incidents, and mechanisms for addressing cross-border problems. Ideally, we'd develop international frameworks that prevent a race to the bottom in regulation, while still allowing for innovation and different approaches suited to different contexts. We should also invest heavily in research, both on making AI systems more safe, transparent, and aligned with human values, and on understanding the economic and social impacts of AI automation. We need better tools for auditing AI, better methods for testing edge cases, better frameworks for embedding complex values into optimization problems. And we need empirical research tracking what actually happens as AI becomes more prevalent in finance, so we can learn from experience and adjust policies accordingly. Perhaps most importantly, we need to maintain humility. We should recognize that we don't have all the answers, that complex systems produce unexpected outcomes, that today's solution might create tomorrow's problem. This suggests building in reversibility where possible, maintaining redundancy and backup systems, and being willing to pump the brakes on deployment when warning signs emerge, even if that means sacrificing some efficiency or innovation speed. There's a tension here between the promise of AI and the need for caution, between moving fast to capture benefits and moving slowly to avoid harms, between embracing innovation and maintaining stability. Different people, different institutions, different societies will strike this balance differently based on their values, their risk tolerance, and their specific circumstances. There's no single right answer that works for everyone, but what we can't afford is to be passive, to simply let AI-controlled finance develop according to market forces and technological momentum without conscious guidance. That path leads almost certainly to outcomes that many of us would find problematic. Concentrated power, reduced accountability, increased inequality, systemic vulnerabilities, and loss of human agency. If we want AI-controlled finance to work well for humanity broadly, we need to actively shape its development starting now. That means having hard conversations about values and priorities. It means making difficult choices about trade-offs. It means investing resources in governance and oversight. It means sometimes accepting less optimization or slower innovation in exchange for greater safety, fairness, and accountability. It means building institutions and practices that didn't exist before. And it means maintaining vigilance, being willing to course-correct when things go wrong, and never becoming complacent just because the technology seems to be working most of the time. Even central banks, the institutions that control national currencies and guide monetary policy, are beginning to explore AI. Some are using machine learning to improve economic forecasting, analyzing vast datasets to predict inflation, unemployment, and growth more accurately. Others are studying how AI might help in detecting financial crises before they occur, or in optimizing interest rate decisions. A few are developing or piloting central bank digital currencies, digital versions of national currencies that could be programmed with smart features and integrated with AI systems for enhanced economic management. Payment systems, too, are increasingly automated. When you tap your phone or card to pay for coffee, AI systems are authenticating the transaction, checking for fraud, routing the payment through multiple intermediaries, and settling the transaction, all in less time than it takes the barista to hand you your cup. Global payment networks process billions of transactions daily, most of them touched by AI in some way. The future of AI-controlled finance is not written yet. We're in the early chapters of this story, and how it unfolds depends on what we do now. Will we build systems that genuinely serve human flourishing, that make finance more accessible and stable, while protecting human agency and dignity? Or will we build systems that concentrate power, reduce accountability, and treat humans as data points in optimization problems? The technology itself doesn't determine the answer. Our choices do. So as you lie there tonight, perhaps thinking about your own money, your own financial future, the economic system you're part of, consider what kind of AI-controlled finance you'd want to see. What values should it embody? What safeguards should it have? Where should humans remain in control? And where might AI genuinely help? These aren't just questions for policymakers and technologists. They're questions for all of us because the answers will shape the world we live in, the opportunities we have, and the kind of society we create. The promise of AI in finance is real. Done right, it could create a more efficient, stable, and accessible financial system that serves people better than what we have today. But the perils are real too. Done poorly, it could create a more fragile, unequal, and inhuman system that serves algorithms and their owners, while leaving most people worse off. The difference between those futures lies in the choices we make, the values we prioritize, and the wisdom we bring to governing these powerful new tools. As we close this exploration, I hope you feel not paralyzed by the complexity or frightened by the risks, but empowered by the recognition that these are human choices. We built this technology. We can shape how it's used. We can insist on safeguards, demand accountability, and work toward futures that reflect our values rather than just our capabilities. The conversation about AI and money has only just begun, and your voice, your concerns, your values matter in how it unfolds. Thank you for joining me on this journey through the possible futures of AI-controlled finance. I hope it's given you something to think about, some perspective on these important questions, and perhaps a bit more clarity about what's at stake and what we might do about it. If you found this exploration valuable, I'd be grateful if you'd like, subscribe, and share your thoughts in the comments. Where do you think AI control of money is heading? What excites you about it? What concerns you? How do you think we should navigate these challenges? I'd love to hear your perspectives. And if this kept you awake, well, at least now you have some fascinating questions to ponder as you drift off. Sweet dreams, and may your financial future, human or AI-controlled, be secure, prosperous, and aligned with what you truly value. Good night. So this is where we are now. We're living in a world where artificial intelligence is already deeply embedded in our financial systems, making decisions that affect our daily lives in ways we often don't see or think about. The infrastructure is in place. The algorithms are running. The data is flowing. And every year, the systems become more sophisticated, more autonomous, and more influential. What we're describing isn't some distant future. It's the present, unfolding around us right now. The question isn't whether AI will be involved in managing our money. It already is. The question is how much control we're willing to give it, how much autonomy these systems should have, and what safeguards we need to put in place to ensure that this increasingly AI-driven financial world serves humanity's best interests. As we drift deeper into this exploration, keep in mind that the line between human-controlled and AI-controlled finance isn't sharp. It's blurry, shifting, and moving steadily in one direction. We're on a continuum, and we've already traveled farther along it than many people realize. Thus, the gradual takeover. How AI could assume control. The future of AI-controlled finance probably won't arrive with a dramatic announcement or a single pivotal moment. There won't be a day when humanity collectively decides to hand over the keys to the economy to our silicon creations. Instead, if artificial intelligence does take control of our money, it will likely happen the way most technological revolutions happen. Gradually, incrementally, one small step at a time, each seeming reasonable and beneficial in isolation, until one day we look around and realize the landscape has fundamentally changed. This gradual takeover has a certain logic to it, even an inevitability. Each step makes sense on its own. Automating routine transactions? That's just efficiency. Using algorithms to detect fraud? That's good security. Letting AI optimize investment portfolios? That's smart financial management. Allowing systems to adjust interest rates or trade currencies based on market conditions? Well, they can react faster than humans, so why not? The path from here to full AI control might unfold something like this. First, we continue expanding the scope of what AI systems can do. Personal finance apps evolve from passive tracking tools to active money managers. Instead of just showing you where your money went, they start making decisions about where it should go. They pay your bills automatically, of course, but they also move money between accounts to maximize interest, automatically invest your spare cash according to your goals, and even make purchases on your behalf when they detect you're running low on essentials. You'd still have oversight, of course. At least initially. The AI would ask permission for larger transactions, alert you to important decisions, and allow you to override its choices. But over time, as you grow to trust the system, as you see it making good decisions consistently, you might start granting it more autonomy. It's convenient after all. Why micromanage when the algorithm seems to know what it's doing? Meanwhile, in the institutional world, banks and financial firms would continue delegating more responsibilities to AI. Loan decisions, already partially automated, become fully automated. The algorithm reviews your application, assesses your risk, sets your interest rate, and approves or denies your request, all without human review except in cases that fall outside normal parameters. Investment firms rely more heavily on algorithmic trading, not just for high-frequency trades, but for long-term strategy as well. Portfolio managers become portfolio overseers, checking on what the AI is doing rather than making decisions themselves. Central banks begin using AI not just for forecasting, but for actual policy decisions. The system monitors economic indicators in real time, thousands of data points updated every second, and adjusts monetary policy accordingly. Interest rates become fluid, changing in tiny increments throughout the day, rather than in quarterly announcements. The AI optimizes for maximum employment, stable prices, and sustainable growth, responding to economic conditions faster and more precisely than any committee of humans ever could. Regulatory bodies, overwhelmed by the complexity and speed of modern finance, increasingly rely on AI to monitor markets and enforce rules. These systems scan millions of transactions, looking for signs of manipulation, insider trading, or systemic risk. When they find something suspicious, they automatically flag it for investigation, or in some cases, automatically intervene to prevent a potential crisis. Humans still make the final decisions, supposedly, but they're mostly rubber stamping what the AI recommends because, well, the AI has access to information and analysis far beyond what any human could process. The integration deepens as different AI systems begin talking to each other, sharing data, coordinating actions. Your personal finance AI communicates with your bank's AI, which communicates with payment networks, which communicate with merchant systems, which feed data to market monitoring AIs, which inform trading algorithms, which influence prices, which affect economic indicators, which guide central bank AIs, which adjust policy, which changes interest rates, which affects your personal finance AI's decisions about your money. It's a vast, interconnected web of algorithmic intelligence, each node making decisions based on what other nodes are doing, all happening at speeds and scales incomprehensible to human minds. At each stage of this evolution, there would be logical reasons to move forward: efficiency, accuracy, speed, convenience, cost savings, better outcomes. And there would be success stories to point to. The AI that saved someone from financial ruin by catching a fraudulent transaction. The robo-advisor that outperformed human wealth managers. The central bank algorithm that successfully navigated a potential recession. These victories would build confidence, momentum, and public acceptance. But there's a tipping point somewhere in this process, a moment when the systems become so complex, so interconnected, and so autonomous that they effectively move beyond human control. Not because anyone decided to relinquish control, but because the systems have evolved to a point where human oversight becomes more theoretical than practical. We might still have the authority to intervene, but the practical ability to do so meaningfully, to understand what the AI is doing and why, to predict the consequences of overriding its decisions, that becomes increasingly difficult. Imagine trying to manually manage a stock portfolio when the AI is processing market data from 10,000 sources simultaneously, updating its models every microsecond, and executing trades faster than you can refresh a web page. Imagine trying to set monetary policy when the AI has analyzed correlations between hundreds of economic variables that you didn't even know were related. You could override it, but would you? Should you? What if you're wrong and the AI was right? What if your intervention causes exactly the problem the AI was trying to prevent? This is what makes the gradual takeover so insidious and, in a strange way, so consensual. At no point does anyone deliberately give up control. At each step, we're just making reasonable choices to use better tools, to automate tedious tasks, to leverage superior analytical capabilities. But incrementally, cumulatively, these choices could lead us to a place where AI isn't just assisting with financial decisions, it's making them. Not through conquest or rebellion, but through the quiet accumulation of trust, dependency, and complexity. There's another factor that could accelerate this process: competition. In a world where some institutions are using advanced AI and others aren't, the ones with AI have enormous advantages. They can trade faster, analyze deeper, respond quicker, and operate more efficiently. This creates pressure on everyone else to adopt similar technology or be left behind. It's an arms race of sorts, not driven by aggression, but by the need to remain competitive. And arms races, once started, tend to escalate. Individual countries face similar dynamics. If one nation's central bank uses AI to optimize its monetary policy and economic management, achieving better growth and stability, other nations feel pressure to do the same or risk being at a disadvantage. If China or the United States or the European Union implements AI-controlled digital currencies with sophisticated features, others must follow or risk their currencies becoming less attractive, less functional, or less trusted. So the takeover, if it happens, would likely be driven not by a conscious decision to hand control to AI, but by countless individual decisions made by companies, institutions, and governments responding to incentives, competition, and the apparent benefits of automation. Each decision makes sense in isolation. Together, they could fundamentally transform who or what controls the flow of money in our world. And perhaps the most subtle aspect of this process is that we might not even notice when we've crossed the threshold. There would be no clear before and after. The change would be gradual enough that each generation would see the new normal as just a natural evolution of what came before. Young people growing up with AI-managed finances might find the idea of manually balancing a checkbook as quaint as we find the idea of bartering chickens. To them, AI control wouldn't be a takeover. It would just be how money works. The question then isn't really whether AI could take control of our money. The trajectory suggests it could, perhaps even that it's likely to, unless we make deliberate choices to limit that progression. The real questions are, how far do we let this go? Where do we draw the lines? And what do we do to ensure that as we build these systems and seed this control, we're creating something that serves humanity rather than something we'll come to regret? Your personal finances under AI management. Let's bring this down to earth, down to the level where most of us experience money in our daily lives, our personal finances. What would it actually feel like to have artificial intelligence managing your money? Not just helping you budget or reminding you to save, but actually controlling your finances, making decisions about how your money is spent, invested, and saved. It's a scenario that might sound either wonderfully convenient or deeply unsettling, depending on your perspective, and perhaps on how much you trust algorithms with your financial well-being. Imagine waking up one morning in this AI-controlled financial world. You check your phone, not to see your account balance, exactly, but to see a dashboard that your personal finance AI has prepared for you. It shows you a summary of recent activity, not transaction by transaction, but in terms of goals and categories. You're on track for your retirement savings. Your emergency fund is adequate. Your spending on entertainment was slightly above optimal this week, but within acceptable variance. A bill is due tomorrow, and I've scheduled payment. Also, I noticed a price drop on that appliance you've been researching, so I purchased it for you. It'll arrive Thursday. That might sound wonderful. The AI is handling all the tedious details of financial life. It's optimizing your spending, ensuring bills are paid, making smart purchasing decisions, and keeping you on track toward your goals. You don't have to think about any of it. You're freed from the mental burden of managing money, liberated to focus on work, relationships, hobbies, the things that actually matter to you rather than whether you remembered to pay the water bill. But there's another side to this scenario, one that becomes apparent when you look a little closer. Let's say you wake up that same morning and think, you know what? I'd like to go out for a nice dinner tonight, somewhere fancy, celebrate a little. You check to see how much discretionary money you have available, and the AI gently informs you that, based on your spending patterns and financial goals, it's allocated only a modest amount for dining out this month, and you've already used most of it. It suggests a less expensive restaurant, or cooking at home, or postponing until next month when the allocation resets. Now, the AI might be objectively correct. Maybe spending that money on an expensive dinner isn't the optimal financial choice. Maybe it would set back your savings goals or push you above the spending threshold the AI has calculated is sustainable for your income. But it's your money, earned by your labor, and the decision of whether to splurge occasionally, even if financially suboptimal, feels like it should be yours to make. Except in this scenario, it's not really yours anymore, not in the way it used to be. You have access to it, but the AI controls it. And while you can probably override the AI's decision, doing so feels like rule-breaking, like going against expert advice, like being financially irresponsible. This tension between optimization and autonomy is at the heart of what makes AI-controlled personal finance so complicated. On one hand, most people aren't perfect financial managers. We make emotional decisions, we procrastinate, we lack discipline, We don't always understand complex financial concepts, and we're susceptible to all sorts of cognitive biases that lead to poor choices. An AI could genuinely help us live better financial lives, helping us save more, spend smarter, invest wisely, and achieve goals we might otherwise fail to reach. On the other hand, money isn't just numbers and optimization problems. It's deeply tied to our sense of autonomy, our ability to make choices, our capacity to be spontaneous or generous, or even foolish if we choose. Sometimes the suboptimal choice is the right choice. Sometimes spending money on something impractical brings joy that can't be quantified. Sometimes giving generously, even when you can't really afford it, is an expression of values that matter more than mathematical efficiency. An AI, at least as we currently understand these systems, doesn't really grasp these nuances. It can be programmed with rules and constraints, of course. You could tell it, always leave me at least this much discretionary spending. Or, don't question charitable donations. Or, let me splurge on my birthday. But that requires you to anticipate all the situations where you might want to override the optimization, to explicitly program in exceptions to algorithmic control. And even then, you're still operating within a framework where the default is AI control and human choice is the exception rather than the rule. Let's think through some specific scenarios. Consider investing. In an AI-controlled system, your investments would be continuously optimized based on your risk tolerance, time horizon, and goals. The AI would rebalance your portfolio not quarterly or annually, but potentially daily or even more frequently if market conditions warranted. It would harvest tax losses automatically, shift allocations as you age, and respond to economic changes far faster than you ever could. This could result in better returns, absolutely. Studies have shown that emotional decision-making, one of the biggest enemies of investment success, would be eliminated. You wouldn't panic and sell during a market downturn. You wouldn't get greedy and overextend during a boom. The AI would maintain discipline, stick to strategy, and make adjustments based on data rather than fear or excitement. But here's a question. What if you wanted to invest in something because you believed in it, even if the expected return wasn't optimal? Maybe you want to invest in green energy companies because you care about climate change, even if fossil fuel stocks might offer better short-term returns. Maybe you want to support local businesses or avoid certain industries for ethical reasons. Would the AI understand that? Could it prioritize your values over pure financial optimization? It could, potentially, if those values were explicitly programmed into its decision-making framework. But that requires you to articulate your values in ways that can be translated into algorithmic rules. Some things translate well. Don't invest in tobacco companies is straightforward. But what about more nuanced ethical considerations? What about situations where your values might conflict with each other, or where you're not even sure exactly how you feel? Human financial advisors can have conversations with you about these things, can help you think through the trade-offs, can adapt to your evolving perspectives. An AI, at least with current technology, is far more rigid. Or consider spending decisions. An AI optimizing your finances might identify all sorts of expenses it considers wasteful or suboptimal. Maybe it notices you subscribe to 3 streaming services but only watch one regularly, so it cancels the other 2. Maybe it sees you buying coffee out several times a week and blocks those purchases, transferring that money to savings instead and suggesting you make coffee at home. Maybe it determines that your car is costing more in maintenance than it's worth and starts pressuring you to sell it and use public transportation or ride-sharing. From a purely financial standpoint, all of these might be good decisions. They'd save you money that could be invested or used for more important goals. But they also impinge on your lifestyle, your choices, your daily pleasures. That morning coffee might be expensive relative to home brewed, but it's also part of your routine, a small ritual that makes your day better. The streaming services might seem redundant, but maybe you like having options, or maybe you share them with family. The car might be costly, but it provides freedom and convenience that's worth more to you than the money saved by giving it up. An AI making these decisions wouldn't understand the subjective value you place on these things unless you explicitly told it. And even then, it might struggle to weigh subjective satisfaction against objective financial metrics. How do you program an algorithm to understand that the coffee isn't just about the caffeine? It's about the walk, the routine, the human interaction with the barista, the feeling of starting the day intentionally. You probably can't, at least not easily. This brings us to a deeper concern about privacy and surveillance. For an AI to manage your finances effectively, it needs comprehensive access to your financial life. Every transaction, every purchase, every source of income, every debt, every asset. It needs to see the full picture. And in practice, it would likely need even more than that. To optimize your spending, it would need to know your preferences, your habits, your goals, your relationships. It might analyze your calendar to predict upcoming expenses, scan your emails for bills or receipts, track your location to understand your spending patterns, even monitor your health to adjust insurance or healthcare spending projections. This level of insight could make the AI incredibly effective at managing your money. But it also means that an AI system, and by extension whoever controls that system, has intimate knowledge of your life. They know where you go, what you buy, who you spend money on, what you value enough to pay for. They know when you're struggling financially, when you're prospering, when you're making questionable decisions. That's an enormous amount of power and a significant invasion of privacy, even if the stated purpose is simply to help you manage your finances better. There's also the question of mistakes and recourse. Humans make financial errors all the time, certainly, but we also have mechanisms for correcting them. If your bank makes a mistake on your account, you can call, explain the situation, and have a human review it and make adjustments. If a financial advisor gives you bad advice, you can hold them accountable, potentially even take legal action. But what happens when an AI makes a mistake? Let's say the algorithm misinterprets some data and makes a poor investment decision that loses you money. Or it blocks a transaction you actually needed to make, causing you to miss a payment or opportunity. Or it categorizes your spending incorrectly and penalizes you within its own optimization framework, restricting your access to funds in ways that cause real problems. Who's responsible? How do you even explain to the AI that it made an error when you might not understand how it reached its decision in the first place? And if the system is complex enough, if it's using deep learning models that even its designers don't fully understand, how can you possibly get meaningful recourse? These aren't just hypothetical concerns. We already see problems with algorithmic decision-making in finance, credit scoring algorithms that disadvantage certain groups, fraud detection systems that flag legitimate transactions based on inscrutable criteria, automated investment platforms that make costly errors during unusual market conditions. As we give AI more control, these problems wouldn't disappear. They'd likely become more common, more impactful, and harder to fix. There's also something more philosophical at stake here, something about the nature of financial responsibility and personal growth. Managing money, making financial decisions, learning from mistakes. These are all part of how we develop as adults. How we learn discipline, delayed gratification, planning, and trade-offs. If AI handles all of that for us, what do we lose? Do we become more financially secure but less financially capable? Do we gain optimization, but lose the skills and judgment that come from wrestling with money ourselves? Think about it this way. If you've never had to budget, never had to make tough choices about spending, never had to experience the consequences of poor financial decisions, are you really financially literate? Or are you just dependent on a system that, if it ever failed or if you ever lost access to it, would leave you helpless? It's a bit like relying entirely on GPS for navigation and then finding yourself unable to read a map or navigate by landmarks when the technology fails. And yet, despite all these concerns, it's not hard to see why people might willingly embrace AI management of their personal finances. For many people, money is a source of stress, anxiety, and confusion. They don't enjoy thinking about it, don't feel confident in their financial decisions, and would genuinely be relieved to hand it over to a system they trust to do a better job. If the AI could demonstrably improve their financial outcomes, help them save for retirement, keep them out of debt, and reduce the mental burden of financial management, that would be a meaningful improvement in their quality of life. The ideal scenario, perhaps, is one where AI assists rather than controls, where it provides insights, suggestions, and automation for routine tasks while leaving significant decisions in human hands. A collaborative model where the AI handles what it's good at, processing data, identifying patterns, optimizing allocations, and humans handle what they're good at, making value-based decisions, weighing intangibles, and maintaining ultimate authority over their financial lives. But maintaining that balance requires intention and effort. It requires deliberately designing systems with appropriate human oversight, building in safeguards against over-automation, and resisting the temptation to hand over more control than we should simply because it's convenient. It requires financial literacy, not less, so that people can meaningfully oversee and evaluate what their AI assistants are doing. And it requires regulatory frameworks that protect individuals' rights, privacy, and autonomy, even as we embrace technological innovation. The personal finance landscape under AI control could be genuinely beneficial, more efficient, more optimized, helping people achieve financial security they might not otherwise reach. But it could also be infantilizing, intrusive, and alienating, reducing us to passive recipients of algorithmic decisions about our own money. Which future we get depends on the choices we make, the systems we build, and the boundaries we establish between helpful automation and excessive control. As you lie there tonight, maybe thinking about your own finances, your own relationship with money, consider how much autonomy you'd be willing to trade for optimization. How much control would you hand to an AI if it promised better outcomes? At what point does convenience become dependence and assistance become control? These are deeply personal questions, but they're ones we may all need to answer sooner than we think. The global economy in AI's hands. Let's zoom out now, up from the level of personal finances to the vast, interconnected machinery of the global economy. If AI control of individual finances would be significant, AI control of the broader financial system would be epical, a transformation on par with the invention of currency itself, or the establishment of central banking. We're talking about artificial intelligence, not just managing your budget or portfolio, but guiding the flow of trillions of dollars, making decisions that affect employment, inflation, trade, and prosperity for billions of people across the entire planet. This might sound like science fiction, and in many ways it still is, but the groundwork is being laid. As we've discussed, algorithmic trading already dominates financial markets. Central banks are beginning to use AI for forecasting and analysis. Digital currencies with programmable features are being developed. The infrastructure that could support AI-controlled economic management isn't something we need to invent from scratch. Much of it already exists, and the rest is actively being built. Let's start with financial markets, the stock exchanges, bond markets, currency markets, and commodity markets where assets are bought and sold, where capital is allocated, where prices are discovered. These markets are already heavily algorithmic, but they still operate within frameworks designed for human participants. There are circuit breakers to halt trading during extreme volatility, opening and closing times based on human work schedules, regulations requiring human disclosure and oversight. In a fully AI-controlled system, these markets would look very different. Trading would be continuous, 24 hours a day, 7 days a week, with no distinction between business hours and off hours. Why have closing bells when the algorithms never sleep? Prices would update constantly, in real time, as AI systems process news, economic data, corporate reports, and countless other inputs. Liquidity would be essentially infinite, as AI market makers stand ready to trade at all times, in all quantities, at prices that adjust microsecond by microsecond to balance supply and demand. This could make markets more efficient in the economic sense. Prices would reflect all available information almost instantaneously. Capital would flow toward its most productive uses with minimal friction. Companies with strong fundamentals would find it easy to raise money, while those with poor prospects would be starved of capital. The invisible hand of the market, guided by artificial intelligence, would allocate resources with unprecedented precision. But there are troubling possibilities here too. One is the potential for cascading failures. When AI systems are all connected, all processing similar data, all optimized for similar goals, they can exhibit herd behavior in ways that amplify rather than dampen market movements. We've already seen hints of this in flash crashes, where algorithmic trading created feedback loops that sent markets plunging before humans could even understand what was happening, let alone intervene. Imagine a scenario where an AI system misinterprets some piece of data or encounters an edge case its training didn't prepare it for. It starts selling perhaps, and other AI systems see that selling and interpret it as a signal, so they start selling too. The feedback loop accelerates, prices plummet, triggering more automated responses, and within seconds or minutes, trillions of dollars in value evaporate. By the time humans realize what's happening and try to intervene, the damage is done. You might think circuit breakers and safeguards would prevent this, and they would to some extent. But those safeguards are themselves becoming algorithmic. AI systems designed to detect and prevent market manipulation or excessive volatility, and that creates its own risks. What if the safeguard systems are themselves susceptible to errors or exploitation? What if bad actors figure out how to trigger the safeguards deliberately, weaponizing them to disrupt markets? The more complex and interconnected these systems become, the harder it is to predict all the ways they might fail or be manipulated. Then there's the matter of central banking and monetary policy. Central banks are among the most powerful institutions in the world, controlling the supply of money, setting interest rates, and taking actions to promote economic stability and growth. Their decisions affect employment, inflation, exchange rates, and ultimately the prosperity of entire nations. Traditionally, these decisions are made by committees of economists and policymakers, deliberating carefully, weighing evidence, making judgment calls about complex, uncertain situations. Could AI do this better? In some ways, perhaps. An AI system could process economic data with far greater speed and comprehension than any human committee. It could monitor thousands of economic indicators simultaneously, detect patterns and correlations invisible to human analysis, and respond to changing conditions almost instantaneously. It could potentially manage the economy more precisely, adjusting interest rates or money supply in tiny increments continuously, rather than making large, discrete changes periodically. Some economists have proposed exactly this, suggesting that AI-guided monetary policy could smooth out business cycles, maintain stable inflation, and achieve better employment outcomes than human-managed central banks. The idea is that many economic problems stem from delayed or imperfect responses to changing conditions. By the time human policymakers recognize a problem, gather data, debate solutions, and implement changes, the economy has already moved on, sometimes making the intervention counterproductive. An AI system could sidestep these delays, responding in real time with precision calibration. But monetary policy isn't just a technical exercise in optimization. It involves profound questions about values and priorities. How much should we tolerate inflation to maintain employment? How much should we sacrifice short-term growth for long-term stability? How should we balance the interests of savers versus borrowers, of workers versus investors, of the present generation versus future ones? These are fundamentally political questions, questions about what kind of economy and society we want. Can an AI make those choices? Should it? One possibility is that humans would still set the goals and values, programming the AI with objectives like maintain inflation near 2% while maximizing employment. The AI would then figure out how to achieve those goals, adjusting its tools and strategies based on results. This is essentially how modern central banks already operate, just with AI doing the implementation instead of human staff. But even this raises issues. Goals that sound straightforward, like maximizing employment, become complicated in practice. Employment for whom? In which sectors? At what wages? An AI optimizing for maximum employment might achieve that goal by creating lots of low-wage, insecure jobs while reducing better-paying positions. Technically, it maximized employment. But is that the outcome we wanted? Without nuanced human judgment, the AI might optimize for the letter of its instructions while missing the spirit. There's also the international dimension to consider. The global economy is a web of interconnected national economies, each with its own currency, its own central bank, its own economic policies. These economies compete and cooperate, engage in trade, invest in each other, and sometimes come into conflict. Exchange rates fluctuate based on economic performance, policy decisions, and market sentiment. Trade balances shift. Capital flows across borders, seeking the best returns. If multiple countries implement AI-controlled monetary policy, these systems would effectively be managing the global economy in a distributed, decentralized way. Each AI pursuing its own nation's interests, each responding to what the others are doing, each trying to optimize outcomes for its own economy in a complex, multiplayer strategic environment. This could lead to more stable international finance, with AI systems coordinating implicitly or explicitly to maintain balance and prevent crises. Or it could lead to something like an AI economic arms race, where each country's system tries to gain advantage over the others, manipulating exchange rates, attracting capital flows, optimizing trade balances in ways that destabilize the global system. Human policymakers already engage in these kinds of strategic interactions, sometimes cooperatively and sometimes competitively. But AI systems operating at machine speed with less transparency and less diplomatic constraint could make these dynamics more volatile and harder to manage. Then there's the realm of fiscal policy, government spending, and taxation. While this is currently the domain of elected officials and is perhaps less likely to be fully automated than monetary policy, AI could still play an increasingly influential role. AI systems could optimize tax collection, identifying evasion and avoidance with unprecedented accuracy. They could analyze the effects of different spending programs, predicting which investments would generate the most economic growth or social benefit. They could even help design tax codes and spending budgets, running complex simulations to find optimal allocations. Some governments are already using AI to improve tax enforcement, scanning financial records to detect discrepancies and underpayment. In theory, this could create a more equitable tax system where everyone pays their fair share and evasion becomes nearly impossible. In practice, it also creates a surveillance state where every financial transaction is monitored and analyzed, and where errors or misunderstandings by the AI could result in penalties for innocent people. International trade is another domain where AI could exert enormous influence. Trade agreements, tariffs, export controls, sanctions. These tools of economic statecraft could be managed, or at least heavily informed by AI systems that analyze trade flows, predict economic impacts, and optimize national interests. Negotiations between countries could increasingly involve AI systems on both sides, processing vast amounts of data and proposing deal structures faster than human negotiators could ever manage. And then there are the truly global systems, the international institutions, like the International Monetary Fund, the World Bank, or the Bank for International Settlements, that help coordinate economic policy and provide financial stability across borders. These institutions could potentially use AI to monitor global financial conditions, detect emerging crises, coordinate responses, and even manage international currencies or payment systems. A global AI system, operating above the level of individual nations, could theoretically optimize the global economy for collective benefit, rather than narrow national interests. But who would control such a system? What values would it optimize for? Who would have the authority to override it or shut it down if it malfunctioned or pursued goals at odds with human welfare? These questions have no easy answers, and the geopolitical tensions involved in creating any kind of global economic governance, whether human or algorithmic, are immense. What makes all of this particularly challenging is the speed and complexity at which AI-driven global finance would operate. Financial markets already move faster than humans can follow. Algorithmic trading happens in microseconds. High-frequency systems complete thousands of transactions in the time it takes you to blink. If AI assumes more control, if economic management becomes increasingly automated, we could reach a point where the economy operates at timescales and complexities that exceed human comprehension. Imagine trying to regulate or oversee an economic system where major decisions are made in milliseconds based on models too complex for any individual to fully understand. Where the AI can explain what it did and why in technical terms, but where no human can truly evaluate whether the decision was correct or optimal. Where cause and effect are so tangled, with so many feedback loops and indirect effects, that even after the fact, it's difficult to judge whether an intervention helped or hurt. This is what some researchers call the black box problem. As AI systems become more sophisticated, especially those using deep learning and other advanced techniques, they become less interpretable. They make accurate predictions and effective decisions, but we can't always see inside them to understand the reasoning. For some applications, that's acceptable. For something as important as managing the global economy, it's deeply troubling. How do we maintain accountability, oversight, and democratic control over economic policy if the systems making the decisions are fundamentally opaque? Yet for all these risks and challenges, the potential benefits of AI-managed global finance are substantial. Economic crises, recessions, financial panics. These have caused immense suffering throughout history. If AI systems could predict and prevent crises, stabilize markets, optimize resource allocation, and maintain prosperity more reliably than human-managed systems, the human benefit could be enormous. Fewer people losing jobs in recessions, fewer life savings wiped out in market crashes, fewer countries trapped in cycles of debt and instability. The question is whether we can capture those benefits while mitigating the risks. Can we build AI systems that are powerful enough to manage the complexity of global finance, but constrained enough to remain safe? Transparent enough for meaningful oversight, but sophisticated enough to be effective? Optimized for human flourishing rather than narrow metrics that miss what really matters? These are the challenges that define the prospect of AI-controlled global economics, and they're challenges we're only beginning to grapple with. As we continue this journey through the implications of AI-controlled finance, keep in mind that the global economy isn't some abstract system. It's the mechanism that determines whether people have jobs, whether families can afford food and housing, whether societies can invest in education and healthcare, whether nations prosper or decline. Handing control of that system to artificial intelligence, even partially, is one of the most consequential decisions humanity could make. And it's a decision we may be making incrementally without quite realizing it, one algorithm at a time. The benefits: efficiency, accuracy, and optimization. Now, let's take a moment to appreciate the genuinely positive side of this possible future. Because for all the concerns and challenges we've explored, there are real, substantial benefits to having AI manage financial systems. If we're going to think seriously about this scenario, we need to consider not just what could go wrong, but what could go right. And quite a lot could go right if the technology develops responsibly and is deployed thoughtfully. Let's start with perhaps the most obvious benefit: efficiency. Financial systems, as they currently operate, involve enormous amounts of redundant effort, wasted time, and unnecessary friction. Consider how a simple transaction works when you buy something with a credit card. Your purchase has to be authenticated, routed through payment networks, checked for fraud, reconciled with merchant accounts, processed by your bank, and logged for reporting. Each of these steps involves systems, intermediaries, and delays. AI can streamline these processes dramatically, reducing transaction times from seconds to milliseconds, cutting costs, and eliminating intermediaries. This makes financial services cheaper and more accessible, especially for people in developing countries or underserved communities who currently face high fees and barriers to accessing banking. Digital payment systems powered by AI could provide banking services to billions of people who currently lack access, enabling them to save safely, send money to family, receive payments for work, and participate in the formal economy. Efficiency extends beyond just transactions. In lending, AI systems can process loan applications far faster than human underwriters, sometimes making decisions in seconds rather than days or weeks. This speed means people can access credit when they need it, whether for emergency expenses, business investments, or home purchases. It also means that businesses can operate more fluidly without having to wait weeks for financing decisions that might determine their survival or success. Then there's accuracy. AI's ability to process vast amounts of data without the errors, fatigue, or biases that affect human decision-making. Consider fraud detection. Human reviewers examining transactions for signs of fraud can only look at a small fraction of the total volume, relying on rules and patterns to flag suspicious activity. But clever fraudsters learn to evade these rules, and human reviewers make mistakes, missing fraud or falsely flagging legitimate transactions. AI systems can analyze every transaction, comparing it against patterns drawn from millions or billions of previous transactions. They can detect subtle anomalies invisible to human reviewers, identifying fraud with greater accuracy and speed. This saves billions of dollars annually and protects consumers from the headache and harm of fraudulent charges. The same principle applies to money laundering detection, terrorist financing prevention, and compliance monitoring. AI can spot patterns of illicit activity that human analysts would miss. In investing, accuracy translates to better returns. AI systems can analyze more data, more quickly, and more thoroughly than human investors. They can identify undervalued assets, predict market movements, and optimize portfolios in ways that consistently outperform human strategies, especially when it comes to avoiding emotional decisions. Fear and greed are powerful forces that cause investors to buy high and sell low, to chase trends and panic during downturns. AI doesn't feel fear or greed. It follows its programming, maintaining discipline, even when markets are chaotic. Studies have shown that robo-advisors often outperform human financial advisors, especially for average retail investors, and they do so while charging a fraction of the fees. For someone saving for retirement, that difference in fees and returns can add up to hundreds of thousands of dollars over a lifetime. That's not trivial. That's the difference between a comfortable retirement and a precarious one. AI-managed investments could help millions of people build wealth they would otherwise never accumulate. Optimization is perhaps the most profound benefit AI brings to finance. Financial systems involve countless decisions, each affecting others in complex ways. How should capital be allocated? What should interest rates be? How should risks be priced? What's the right balance between growth and stability? These are optimization problems, mathematical puzzles with thousands or millions of variables, and AI is extraordinarily good at solving them. In personal finance, optimization means AI can help individuals achieve their goals with the resources they have. It can find the perfect balance between saving and spending, determine the ideal asset allocation for someone's specific situation, identify tax-saving opportunities, and adjust strategies as circumstances change. For someone without the knowledge, time, or money to hire a financial advisor, this AI guidance could be transformative. At the institutional level, optimization means better capital allocation across the economy. Money flows to where it's most productive, where it can generate the most value, create the most jobs, fuel the most innovation. Businesses with good ideas but poor access to traditional funding could find capital through AI systems that recognize their potential. Regions that have been neglected by human investors might receive investment when AI systems identify opportunities others have missed. The result could be faster economic growth, more innovation, and broader prosperity. AI could also optimize risk management, one of the most critical functions in finance. Financial crises often occur because risks are mispriced or misunderstood, because correlations that seem unlikely turn out to be real, because small problems cascade into large ones. AI systems could monitor risk continuously across the entire financial system, identifying vulnerabilities before they become catastrophes, recommending interventions, and ensuring that banks, investors, and institutions maintain appropriate buffers against shocks. This improved risk management could make the financial system more stable, reducing the frequency and severity of crises. Think about what that would mean in human terms. The 2008 financial crisis cost millions of people their homes, their jobs, their savings, their security. It took years for economies to recover, and some communities never fully did. If AI could prevent or mitigate such crises, the human benefit would be incalculable. Families would be spared the trauma of foreclosure, workers would avoid the despair of unemployment, retirees would see their nest eggs protected. There's also the potential for AI to reduce inequality in access to financial services. Currently, sophisticated financial tools, personalized advice, complex investment strategies. These are mostly available to wealthy individuals who can afford high fees and minimum account balances. Everyone else makes do with basic services or no services at all. AI democratizes access. A robo-advisor can provide sophisticated portfolio management to someone with $1,000 just as easily as to someone with $1 million. AI financial planning tools can offer personalized guidance without charging hourly rates that put them out of reach for most people. In lending, AI could reduce discrimination. Human lenders, even with the best intentions, carry biases that affect their decisions, sometimes unconsciously favoring borrowers who look like them or come from similar backgrounds. AI systems, properly designed and trained on appropriate data, can make lending decisions based purely on creditworthiness, without regard to race, gender, or other protected characteristics. This could expand access to credit for groups that have historically been denied fair treatment in financial services. We should note, of course, that AI can also perpetuate or amplify bias if it's trained on biased data, but this is a solvable problem. We can audit AI systems for fairness, adjust their training data, and constrain their decision-making to avoid discriminatory outcomes. We can't as easily fix human biases that are subconscious or deeply ingrained. In this sense, AI might actually be fairer than human decision-makers once we've done the work to make them so. AI could also contribute to financial literacy and education. Imagine AI assistants that don't just manage your money, but help you understand the decisions being made, that answer questions in plain language, that teach you about investing, budgeting, and financial planning through patient, personalized instruction. For millions of people who never learned these skills, who find finance intimidating or confusing, AI tutors could provide the knowledge they need to take control of their financial lives, even if they choose to have AI assistance in implementing that control. From a macroeconomic perspective, AI-guided policy could potentially smooth out business cycles, preventing recessions, or at least making them less severe and shorter. The economy could operate closer to full employment more consistently. Inflation could be kept stable without sacrificing growth, and resources could be allocated more efficiently. The result would be higher living standards, less economic anxiety, and more opportunities for everyone. There's something profound here about human potential being unleashed. So much time, energy, and mental bandwidth is currently consumed by financial concerns. People work jobs they hate because they need the money. They delay pursuing education or training because they can't afford it. They stay in bad situations, whether employment, relationships, or locations, because they lack the financial flexibility to change. They lie awake at night, worrying about bills, debt, whether they'll have enough for retirement, or their children's education. If AI systems could manage these concerns effectively, providing everyone with a baseline of financial security and optimization, imagine what people could do with that freed mental space and energy. They could focus on creative pursuits, on relationships, on learning, on contributing to their communities. They could take chances on entrepreneurship or career changes without risking financial ruin. They could be more generous, more experimental, more fully themselves, because the basic financial anxiety that haunts so many lives would be eased by competent, tireless AI management. This is the optimistic vision of AI-controlled finance, a world where technology genuinely serves humanity, where the efficiency and accuracy of machines complement human values and aspirations, where financial systems work better for everyone rather than just for those wealthy or knowledgeable enough to navigate them skillfully. It's not an unrealistic vision. Much of this is already happening in early forms, and the trajectory toward more comprehensive AI involvement seems clear. But, and this is an important but, realizing these benefits requires intentional effort. It requires building AI systems with the right objectives, training them on appropriate data, constraining them with proper safeguards, and maintaining meaningful human oversight. The benefits don't come automatically just because we use AI. They come from using it well, thoughtfully, with attention to both the opportunities and the risks. And that brings us to the other side of this coin, the very real dangers that accompany the potential benefits, the ways in which AI control of finance could go wrong, sometimes catastrophically so. But before we venture into those darker waters, let's rest here for a moment in the positive possibilities. Let's imagine a world where AI helps people achieve financial security, where it stabilizes markets and prevents crises, where it democratizes access to sophisticated financial services, where it frees humanity from financial anxiety to pursue what truly matters. That world is possible. Whether it's probable depends on the choices we make starting now. And those choices require understanding not just the promise, but also the peril, the dark side, risks, vulnerabilities, and dangers. Now we turn to the shadows, to the concerns that keep technologists and policymakers awake at night, to the ways in which AI control of money could create problems as serious or more serious than those it solves. Because for every benefit we've just explored, there's a corresponding risk. For every optimization, a potential for brittleness. For every increase in efficiency, a possible loss of resilience. The promise of AI in finance is genuine, but so are the perils, and understanding both is essential to navigating this future wisely. Let's begin with the most fundamental concern: systemic risk and catastrophic failure. Financial systems are complex, interdependent networks, where small problems can cascade into large ones. The more automated and interconnected these systems become, the more potential there is for rapid, widespread failures that propagate through the entire network faster than humans can respond. Consider a scenario. An AI system managing a major investment fund encounters an unusual market condition, something outside its training data, an edge case its developers never anticipated. It makes a decision that seems rational based on its programming, but turns out to be wrong. It starts selling assets. Other AI systems, monitoring the same markets, see this selling and interpret it as a signal. Maybe they think the first system knows something they don't, or maybe their algorithms are simply programmed to follow momentum. They start selling too. The selling accelerates. Prices drop. More AI systems react. Risk management algorithms across the financial system trigger automatic defensive measures, pulling back from markets, liquidating positions, cutting exposure. Within minutes, what started as one system's error has become a market-wide panic, not because any of the AI systems made individually unreasonable decisions, but because their collective behavior created a feedback loop that spiraled out of control. This isn't purely theoretical. Flash crashes have already occurred in markets dominated by algorithmic trading. On May 6, 2010, US stock markets experienced a flash crash that saw the Dow Jones Industrial Average plunge nearly 1,000 points in minutes before recovering. The crash was triggered by a large automated sell order that overwhelmed the market's ability to absorb it, causing algorithmic trading systems to rapidly withdraw liquidity, which accelerated the decline in a vicious cycle. While circuit breakers eventually halted the fall, the event demonstrated how quickly automated systems could destabilize markets. Now imagine this happening not just in stock markets, but across all financial systems simultaneously. Banking systems, payment networks, currency markets, commodity exchanges, all interconnected, all partially or largely controlled by AI, all vulnerable to cascading failures. A problem that starts in one corner of the global financial system could propagate everywhere within seconds or minutes, causing banks to freeze accounts, payment systems to stop working, ATMs to shut down, markets to crash, and the entire economic machinery to seize up. The recovery from such an event could be enormously difficult. With human-managed systems, we can usually identify what went wrong, where the error occurred, how to fix it. But with complex AI systems, especially those using advanced machine learning techniques, understanding why something happened can be extraordinarily difficult. The decision-making process might be distributed across millions of parameters in a neural network, with no clear chain of reasoning that humans can follow. It's the black box problem again, and it becomes especially dangerous in crisis situations where rapid diagnosis and correction are essential. Worse, if the systems are deeply interconnected and operating at machine speed, by the time humans figure out what's happening and decide how to intervene, the damage may already be catastrophic. It's like trying to stop a chain reaction after it's already begun, possible in theory, but requiring split-second timing and perfect execution that may not be feasible in practice. Then there's the risk of algorithmic bias and inequality. We touched on this earlier in the context of personal finance, but it's worth exploring more deeply because it's one of the most insidious dangers of AI-controlled finance. AI systems learn from data, and if that data reflects historical biases and inequalities, the AI will learn to perpetuate them, often in ways that are subtle and hard to detect. Consider credit scoring. Traditional credit scoring has well-documented biases that disadvantage minority communities, people from lower income backgrounds, and others who don't fit the profile of the ideal borrower as historically defined. If we train AI systems on this historical data, they'll learn those same biases. They might even amplify them, finding correlations in the data that weren't explicitly programmed, but that serve as proxies for protected characteristics. For example, an AI might learn that people from certain zip codes are higher credit risks, not because of anything about those individuals, but because those zip codes correlate with race or class. The AI isn't explicitly discriminating based on race, which would be illegal, but it achieves the same discriminatory outcome through proxy variables. And because the AI's decision-making is opaque, because it's based on complex patterns in large datasets, it can be very difficult to detect and correct this bias. The consequences of such bias can be severe and self-perpetuating. If people are systematically denied credit or charged higher interest rates because of biased algorithms, they have fewer opportunities to build wealth, to invest in education, to start businesses, to move to better neighborhoods. Their economic circumstances worsen, which generates more data showing them as higher risk, which reinforces the bias in the next iteration of the model. It becomes a vicious cycle, with AI systems entrenching and amplifying existing inequalities rather than reducing them. This concern extends beyond credit to all areas where AI makes decisions about people's financial lives. Employment algorithms that screen job applications might discriminate based on names, addresses, or education that correlate with protected characteristics. Insurance algorithms might charge higher premiums to people from certain communities. Investment algorithms might steer money away from minority-owned businesses or low-income areas. In each case, the bias might not be intentional, might not be explicitly programmed, but it emerges from the patterns in the data and the objectives the AI is optimized for. The challenge is that detecting and correcting these biases requires constant vigilance, careful auditing, and often trade-offs between accuracy and fairness. An algorithm that's most accurate at predicting credit risk might also be the most discriminatory. Do we accept some loss of accuracy to achieve fairness? Who decides where that balance should be? And how do we enforce those decisions when the systems are proprietary? when the companies operating them resist transparency, when the biases are subtle enough to deny plausibly. Next, let's consider cybersecurity threats. Financial systems are already prime targets for hackers, thieves, and hostile nation-states. The more we concentrate financial control in AI systems, the more attractive and vulnerable those systems become. A successful attack on a major AI-controlled financial platform could have consequences far beyond traditional hacking. It's not just stealing money, though that would certainly happen. It's the potential to manipulate the AI itself, to alter its decision-making, to use it as a weapon. Imagine a sophisticated attacker who gains access to an AI system managing a major bank or investment fund. Instead of simply draining accounts, which would be noticed immediately, they subtly alter the AI's programming or training data. They introduce biases that benefit their own investments. They program in vulnerabilities they can exploit later. They set up conditions that will trigger catastrophic failures at a predetermined time, perhaps timed to coincide with other attacks or geopolitical events. Because AI systems are complex and often opaque, such manipulation might go undetected for months or years. The AI would appear to be functioning normally, making reasonable decisions, generating acceptable results. But underneath, it's been compromised, made into an instrument of those who hacked it. And when the trap is finally sprung, when the hidden vulnerabilities are exploited, the resulting crisis could dwarf anything we've seen from traditional cyber attacks. There's also the risk of AI systems being weaponized deliberately by nation-states or terrorist organizations. Economic warfare is already a reality, with countries using sanctions, tariffs, and financial restrictions as tools of foreign policy. AI-controlled finance raises the stakes dramatically. An adversary who could hack into or manipulate another nation's financial AI systems could potentially cripple that nation's economy without firing a shot, causing bank failures, market crashes, currency collapse, and economic chaos that could take years to recover from. Even without malicious intent, the concentration of financial control in AI systems creates vulnerability to simple technological failure. Software has bugs, hardware fails, networks go down. In human-managed financial systems, we have redundancy, backups, manual override procedures. People can step in when computers fail. But as systems become more automated and complex, as human expertise atrophies from disuse, our ability to fall back on manual operation degrades. If a critical AI system fails, do we even have people who understand the system well enough to operate it manually? Do we have procedures in place? Or do we just have to wait, hope the system can be rebooted, and suffer the consequences in the meantime? Another deeply troubling risk is the loss of human agency and accountability. As we delegate more financial decisions to AI, we create a situation where important choices affecting people's lives are made by systems that can't be reasoned with, appealed to, or held morally responsible. If an AI denies you a loan, prevents you from accessing your money, makes an investment decision that costs you your retirement savings, who's accountable? The company that made the AI, the programmers who wrote the code, the regulators who approved its use. In practice, the diffusion of responsibility that comes with AI decision-making often means that no one is truly accountable. The company blames the algorithm. The programmers say they were following specifications. The regulators claim they couldn't have foreseen the specific problem. The person harmed by the decision has no clear path to recourse, no one to appeal to who can override the AI's judgment with human empathy or common sense. This loss of accountability is particularly concerning in a domain as important as finance. Financial decisions can determine whether someone can buy a home, start a business, afford medical care, send children to college, retire with dignity. These are matters of profound human consequence. The idea that they could be determined by algorithms that operate according to inscrutable logic, that can't explain their decisions in meaningful human terms, that can't be moved by compassion or special circumstances, this is dystopian in a very real sense. There's also the philosophical concern about values and priorities. AI systems optimize for whatever objectives we give them, but translating complex human values into mathematical objective functions is extraordinarily difficult. What happens when the objective function we've programmed into our financial AI doesn't fully capture what we actually care about? For instance, we might tell an AI to maximize economic growth. Seems straightforward, right? But growth of what? GDP, employment, corporate profits. And at what cost? An AI optimizing blindly for growth might achieve that goal by creating terrible working conditions, by destroying the environment, by concentrating wealth in ways that create social instability, by sacrificing long-term sustainability for short-term gains. Technically, it's doing what we asked, but it's missing the nuance of what we actually value. This is sometimes called the alignment problem in AI safety research. How do we align AI objectives with human values when human values are complex, contextual, sometimes contradictory, and not easily reduced to mathematical formulas? It's easy to get the alignment wrong, to create systems that optimize for what we said we wanted rather than what we actually want. And in finance, where the stakes are so high and the impact so broad, misaligned AI could cause enormous harm even while technically succeeding at its programmed objectives. There's also a risk of AI systems enabling or facilitating financial crimes in new ways. Money laundering, fraud, market manipulation, these might become easier if criminals can exploit AI systems or use AI to evade detection. An AI tool designed to optimize tax strategies could be repurposed for tax evasion. An AI that finds inefficiencies in markets could be used to manipulate prices. The same technology that makes finance more efficient could also make financial crime more sophisticated, and the arms race between crime detection AI and crime committing AI could escalate in troubling ways. We should also consider the risk of financial exclusion and digital divides. While AI could theoretically democratize access to financial services, it could also create new forms of exclusion. People who lack digital literacy, who don't have reliable internet access, who don't trust technology, or who simply prefer human interaction, might find themselves increasingly locked out of financial services as banks and institutions shift to AI-driven, digital-first models. Elderly populations, people in rural areas with poor connectivity, individuals with disabilities that make it difficult to use standard digital interfaces, immigrants who face language barriers, all of these groups could be disadvantaged in an AI-controlled financial system. And without deliberate effort to maintain accessibility and provide alternatives, the shift to AI finance could exacerbate rather than reduce inequality. Finally, there's the risk of what we might call financial infantilization or de-skilling. If AI manages all our money, makes all our financial decisions, and shields us from the consequences of our choices, do we lose important capacities? Do we become financially illiterate, unable to manage money without AI assistance? And if so, what happens to individuals or societies if the AI systems fail or become unavailable? It's similar to how GPS navigation has made many people unable to read maps or navigate without technological assistance. That's mostly a harmless convenience, but financial de-skilling could have more serious consequences. Financial literacy, the ability to understand and manage money, to make informed decisions about spending, saving, and investing, is an important life skill. If we outsource it entirely to AI, we may lose not just the skill, but also the sense of agency and responsibility that comes with managing our own economic lives. These risks, from systemic failures to bias to cyber attacks to loss of human agency, they're not hypothetical scare stories meant to frighten people away from technology. They're genuine concerns rooted in real problems we're already seeing in early AI systems, projected forward to a world where AI has even more control and influence. That doesn't mean we should reject AI in finance. The benefits are real too, as we've discussed. But it does mean we need to be clear-headed about the dangers, thoughtful about how we mitigate them, and humble about the limits of our ability to predict and control these complex systems. The path to beneficial AI-controlled finance, if there is one, runs between the perils we've explored here. It requires building robust safeguards, maintaining meaningful human oversight, ensuring transparency and accountability, auditing for bias and fairness, protecting against cyber threats, and preserving human agency even as we embrace automation. It's a narrow path, and staying on it will require vigilance, wisdom, and a willingness to pump the brakes when necessary, even if the technology could race ahead. Whether we can walk that path successfully remains one of the great open questions of our technological age. Beyond the technical challenges of AI-controlled finance, beyond the risks of system failures and algorithmic bias, there's another dimension we need to consider: the human cost. What happens to the millions of people whose livelihoods depend on jobs that AI could perform better, faster, and cheaper? What happens to communities built around financial services when those services no longer require human workers? What happens to society when the distribution of wealth and opportunity shifts dramatically in favor of those who own and control AI systems? These aren't just economic questions. They're questions about the fabric of our society, about dignity, purpose, and what it means to thrive in a world where machines can do more and more of what humans once did. Let's start with the most immediate impact: job displacement. The financial services industry employs millions of people around the world. Bank tellers, loan officers, financial advisors, accountants, traders, insurance agents, customer service representatives, compliance officers, and countless other roles that involve processing information, making decisions, and providing services related to money. Many of these jobs are precisely the kind that AI excels at automating. We've already seen the beginning of this transformation. Bank branches are closing as customers shift to online and mobile banking. Robo-advisors are replacing human financial advisors for routine investment management. Automated underwriting systems are evaluating loan applications without human review. Chatbots are handling customer inquiries that once required human representatives. Algorithmic trading has displaced floor traders and reduced the number of humans involved in executing and managing trades. This trend would accelerate dramatically in a world where AI assumes greater control over financial systems. Why employ hundreds of loan officers when an AI can evaluate applications instantly with greater accuracy? Why maintain large customer service departments when AI chatbots can handle 90% of inquiries and only escalate truly complex issues to humans? Why pay for human financial advisors when AI systems can manage portfolios more effectively at a fraction of the cost? The counterargument, often made by technology optimists, is that while AI may eliminate some jobs, it will also create new ones. History shows that technological revolutions typically create more jobs than they destroy, even if those jobs are different from the ones that vanished. The printing press put scribes out of work, but created jobs for printers, publishers, and eventually an entire literate workforce. Automobiles replaced horse-drawn carriages, but generated enormous employment in manufacturing, maintenance, and all the industries that grew up around car culture. But there are reasons to think AI might be different, that this time the displacement might be more severe and the adjustment more painful. First, the pace of change is much faster. Previous technological transitions unfolded over generations, giving workers time to retrain, giving education systems time to adapt, giving society time to adjust. AI is developing and deploying in years or decades, not generations. The people whose jobs are automated may not have time to retrain for new roles before those roles are also automated. Second, AI doesn't just automate physical tasks or routine processes. It's increasingly capable of handling cognitive work, judgment, decision-making, the kinds of tasks that humans have traditionally been uniquely good at. A factory worker displaced by robotics might retrain as an accountant or analyst. But if AI can do accounting and analysis better than humans, where does that worker go? What's the next tier of work that only humans can do, and how long before AI reaches that too? Third, the jobs that AI creates might be fewer in number and require higher skills than the jobs it eliminates. Yes, we'll need people to design, build, maintain, and oversee AI systems. But those are specialized roles requiring advanced education in computer science, data science, and engineering. They're not accessible to the average bank teller or insurance agent without years of retraining. and there simply aren't enough of those jobs to absorb everyone displaced from more routine roles. The result could be a significant and lasting increase in unemployment or underemployment, particularly among middle-skill workers who have traditionally found good jobs in financial services. These aren't minimum-wage service jobs. These are often respectable middle-class careers with decent pay and benefits. When those jobs disappear, the people who held them don't just lose income. They lose purpose, identity, connection to their communities, and the sense of dignity that comes from productive work. The social consequences of widespread unemployment are well documented and troubling. Communities that lose their economic base suffer from increased rates of depression, substance abuse, domestic violence, and other social pathologies. Young people growing up in areas with limited economic opportunity often struggle to envision successful futures for themselves. The social fabric frays as people lose the structures and rhythms that work provides. Moreover, job loss in financial services wouldn't happen in isolation. AI is transforming many sectors simultaneously. Manufacturing, transportation, retail, healthcare, legal services, journalism, and many others are all experiencing or anticipating significant automation. The cumulative effect across all these industries could be a massive disruption to labor markets, creating a large population of displaced workers competing for a shrinking pool of jobs that still require human labor. This brings us to the question of wealth distribution and inequality. AI systems and the infrastructure that supports them represent significant capital investments. The companies and individuals who own these systems, who control the AI, capture most of the economic value they generate. If AI manages trillions of dollars in assets, processing millions of transactions, generating enormous profits in the process, that wealth flows primarily to the owners of the AI, not to the displaced workers who once performed those functions. This could dramatically accelerate wealth concentration, creating a small class of AI owners and controllers who accumulate vast fortunes, while a much larger class of workers sees their income and opportunities decline. Some economists worry about a future where returns to capital completely dominate returns to labor, where owning AI and data becomes the only path to prosperity, and where most people are economically superfluous, unable to compete with machines, and unable to access the capital needed to own them. This isn't just an economic problem, it's a political and social one. Societies with extreme inequality tend to be unstable, with high levels of social tension, political polarization, and sometimes violence. When large segments of the population feel economically marginalized, when they see others prospering while their own situations deteriorate, when they lose hope in social mobility and fair opportunity, they may turn to radical politics, authoritarian leaders, or social unrest. History offers cautionary examples. The Industrial Revolution, while ultimately creating widespread prosperity, also produced a long period of worker exploitation, social upheaval, and political instability. It took decades of labor organizing, progressive reforms, and social safety net development to create societies where the gains from industrialization were more broadly shared. We may face a similar challenge with AI, but compressed into a much shorter time frame and with potentially more profound consequences. Some proposals have emerged to address these concerns. Universal Basic Income, or UBI, is one frequently discussed option. The idea is that if AI-generated wealth concentrates in fewer hands, we could tax that wealth and redistribute it as a guaranteed income for all citizens, ensuring everyone has at least a basic level of economic security, regardless of their employment status. This would theoretically allow people to live with dignity, even if AI has made their labor economically unnecessary. But UBI raises its own questions. At what level should the income be set? Who funds it, and how? What happens to the social and psychological benefits of work, the sense of purpose and contribution that employment provides? Would people be content to live on government stipends, while a small elite controls the productive capital of society? Or would that create resentment and social division? Other proposals include massive public investment in education and retraining, helping workers transition to new roles that AI can't easily automate. or restructuring work itself, moving towards shorter work weeks and job sharing so that available work is distributed more broadly. Or developing new forms of ownership where workers or citizens have stakes in the AI systems and share in the wealth they generate, perhaps through sovereign wealth funds or worker cooperatives that own AI capital. Each of these approaches has merits and challenges, and none is a complete solution on its own. What's clear is that managing the social and economic impact of AI-controlled finance and AI automation more broadly will require deliberate policy choices, social innovation, and a willingness to rethink fundamental assumptions about work, wealth, and the social contract. There's also a cultural dimension to consider. In many societies, work is deeply tied to identity and self-worth. What do you do is often the first question we ask when meeting someone new, and the answer shapes how we perceive them and how they perceive themselves. A world where many people can't work, or where their work is seen as economically marginal, could create profound challenges for individual and collective identity. Some optimists imagine a future where liberation from work allows humans to pursue creativity, learning, relationships, and self-actualization without the pressure of earning a living. A world where everyone has time to paint, write poetry, play music, volunteer in their communities, raise children with full attention, or simply rest and enjoy life. In this vision, AI taking over work isn't a crisis, but an opportunity, freeing humanity from toil to pursue what truly matters. That's a beautiful vision, but it requires a significant cultural shift. It requires reimagining what gives life meaning, what makes someone valuable, how we structure our days and measure success. It requires developing new institutions and social practices that provide the community, purpose, and structure that work currently provides. This kind of cultural transformation doesn't happen quickly or easily, and the transition period could be difficult and painful even if the destination is ultimately positive. We should also consider international dimensions. The impacts of AI-controlled finance won't be distributed evenly across countries. Nations with advanced technology sectors, strong education systems, and capital to invest in AI will likely benefit disproportionately. They'll capture the wealth generated by AI, while countries that primarily provide labor or raw materials could find themselves increasingly marginalized in the global economy. This could exacerbate international inequality, creating a new form of colonialism or dependency where a few technologically advanced nations control the AI systems that manage global finance, while other nations become economically subordinate, unable to compete and unable to develop their own AI capabilities, because the winners have such significant advantages in data, talent, and capital. Alternatively, if AI dramatically lowers the cost of financial services and increases access, it could help developing nations leap forward, providing banking and investment services to populations that currently lack access. Mobile banking has already transformed financial inclusion in parts of Africa and Asia. AI-powered financial services could accelerate this trend, potentially reducing global poverty and enabling development in ways that traditional financial systems never could. Which scenario unfolds depends largely on policy choices, international cooperation, and whether the benefits of AI-controlled finance are hoarded by a few or shared broadly. It depends on whether we build these systems with global equity in mind or whether we allow market forces alone to determine outcomes. As we consider these social and economic impacts, it's worth remembering that they're not inevitable consequences of technology. They're outcomes that result from how we choose to develop and deploy AI, how we structure our economies and societies in response, and what values we prioritize in making those choices. Technology creates possibilities and pressures, but humans still make the decisions that determine how those possibilities unfold. The question isn't whether AI will impact employment and wealth distribution. It clearly will. The question is whether we'll manage that impact proactively, with concern for human welfare and social stability, or whether we'll let it happen haphazardly, dealing with consequences only after they've created serious problems. The difference between those paths could mean the difference between a future where AI-controlled finance benefits humanity broadly, or one where it creates a deeply divided, unstable world that most people experience as a loss rather than a gain. offer ethical dilemmas and controversial decisions. Let's turn now to perhaps the most philosophically challenging aspect of AI-controlled finance: the ethical dilemmas that arise when we delegate moral decisions to machines. Because finance isn't just about numbers and efficiency, it's about values. Every financial decision, from the personal to the global, involves trade-offs, competing interests, and moral considerations. Who gets the loan and who doesn't? How should we balance growth against stability? What's fair compensation for work? How much inequality is acceptable? These questions don't have purely technical answers. They require moral judgment. And that raises a profound question. Can AI make moral judgments? Should it? Let's start with a specific scenario, the kind of decision that AI-controlled financial systems would face regularly. Imagine an AI managing a bank's lending operations. It receives 2 loan applications. Both applicants need the money for essential purposes, let's say medical care. Both have similar credit scores and financial situations. But the AI's models predict that one applicant is slightly more likely to repay the loan based on subtle patterns in the data, patterns too complex for humans to discern, but clear to the algorithm. From a pure risk management perspective, the AI should approve the loan with the better predicted repayment probability. That's rational. That's maximizing the bank's returns. That's what the AI was programmed to do. But what if the pattern that makes one applicant higher risk correlates with factors beyond their control? What if it reflects systemic disadvantages they've faced? What if the difference in predicted repayment probability is tiny within the margin of error, but the AI treats it as decisive because it's optimizing for maximum returns? A human loan officer might look at this situation and make a different call. They might consider the circumstances, the human need, the fact that medical care is a matter of health and potentially life. They might decide that the tiny difference in risk doesn't justify denying someone access to necessary treatment. They're making a moral judgment that fairness, compassion, and human need should sometimes outweigh pure economic optimization. Can an AI make that judgment? Should it? This is a version of what philosophers call the trolley problem, a thought experiment about moral decision-making. In the classic version, a runaway trolley is heading toward 5 people on the tracks. You can pull a lever to divert it onto another track, but there's one person on that track. Do you pull the lever, actively causing 1 death to save 5? There's no objectively correct answer. It depends on your moral framework, your values, your intuitions about responsibility and consequences. Financial AI faces trolley problems constantly, though usually less dramatically. Should the AI prioritize returns for investors or financial stability for the broader economy? Should it maximize short-term profits or long-term sustainability? Should it treat all customers equally according to risk models? Or should it account for historical disadvantages and systemic inequalities? Should it optimize for efficiency even if that causes job losses? Or should it factor in social costs? These decisions require value judgments. And someone has to program those values into the AI. The programmers, the company leadership, the regulators, someone has to decide what the AI optimizes for, what trade-offs it makes, what it prioritizes when objectives conflict. This is an enormous responsibility and a troubling concentration of power. A small group of people, writing code and setting parameters, could effectively be making moral decisions that affect millions or billions of others. And here's the uncomfortable truth. Those programmers and executives may not be representative of the broader population. They're likely to come from similar backgrounds, hold similar values, face similar incentives. Their moral judgments, embedded in AI systems, become the moral judgments imposed on everyone who interacts with those systems. But who elected them to that position? Who oversees their choices? How do we ensure that the values encoded in AI reflect some kind of democratic consensus, rather than the preferences of a narrow elite? There's also the question of transparency. If an AI makes a decision that harms you, do you have a right to understand why? In human systems, we generally expect explanations. If a bank denies your loan application, they have to tell you why. If a judge sentences you, They explain their reasoning. This transparency allows for accountability, appeal, and learning. But AI systems, especially those using deep learning and complex models, often can't provide satisfying explanations. They can tell you that their model predicted a certain outcome, but they can't always explain in human understandable terms why the model reached that prediction. This creates what we might call a transparency performance trade-off. Simpler AI systems that follow clear rules are more transparent but less capable. More sophisticated systems that can capture complex patterns and make better predictions are often opaque, black boxes whose reasoning we can't fully access. For many applications, we choose performance over transparency because the benefits of accuracy outweigh the costs of opacity. But for decisions with moral dimensions, decisions that significantly affect people's lives, that trade-off becomes much more troubling. Consider a scenario where an AI system managing a pension fund makes investment decisions that, while optimizing returns, inadvertently support industries that harm the environment or exploit workers. The pensioners, who are ultimately the beneficial owners of that money, might have moral objections to such investments if they knew about them. But if the AI's decision-making is opaque, if its investment strategies are too complex for laypeople to understand, how can those pensioners exercise meaningful control over how their money is used? This is a question of moral agency. If we delegate financial decisions to AI, are we also delegating moral responsibility? Can we say the AI did it and wash our hands of the ethical implications? Most ethical frameworks would say no, that we remain responsible for the systems we create and deploy, for the values we program into them, and for the outcomes they produce. But in practice, the diffusion of responsibility that AI creates makes it very difficult to maintain meaningful accountability. There's a particular challenge around AI and what we might call moral edge cases, situations where standard rules break down and human judgment becomes essential. Imagine an AI-controlled banking system during a natural disaster. People need access to money for emergency supplies, evacuation, survival. But the normal authentication systems aren't working. Networks are down. Identification has been lost. Usual procedures are impossible to follow. A human bank manager in that situation might override normal rules, providing access to funds based on informal identification, community knowledge, or simply trusting people in a crisis. They're exercising moral judgment, recognizing that rigid adherence to protocol would cause harm in this unusual situation. Can an AI do that? Can it recognize when normal rules should be suspended? Can it balance the risk of fraud against the moral imperative to help people in crisis? We could try to program in exceptions for emergencies, of course. But emergencies come in countless forms, many of them unpredictable. And the appropriate response often depends on context, on specific circumstances that are difficult to anticipate and code for. Human moral judgment involves intuition, empathy, and the ability to reason about novel situations using general principles. We don't yet have AI that can replicate that kind of flexible moral reasoning, and it's not clear that we will anytime soon. This limitation of AI moral reasoning becomes especially problematic in situations involving competing rights or values. Consider a scenario where an AI must choose between protecting customer privacy and preventing financial crime. Both are legitimate concerns. Privacy is a fundamental right. Preventing crime is a social necessity. But in specific situations, they may conflict. Detecting money laundering might require accessing transaction data in ways that compromise privacy. Where should the balance be? Different societies, different legal systems, different cultural contexts would answer this question differently. What's considered an appropriate balance in one context might be seen as invasive surveillance in another, or as negligent failure to prevent crime in a third. An AI system deployed globally would need to navigate these different moral and legal frameworks, making context-dependent decisions that respect local values while maintaining some consistency. That's an extraordinarily difficult challenge. There's also the question of moral learning and evolution. Human moral understanding changes over time. Things that were once considered acceptable, like certain forms of discrimination or exploitation, are now recognized as wrong. Conversely, behaviors once condemned might become accepted as societies evolve. This moral progress happens through dialogue, experience, cultural change, and deliberation. But AI systems are trained on historical data. They learn from the past. This makes them inherently conservative, biased toward replicating historical norms rather than evolving beyond them. If we want AI to embody our best moral values rather than simply replicating past practices, we need some way to update their moral frameworks as society's understanding develops. But who decides what counts as moral progress versus moral decline? Who has the authority to update the values encoded in AI systems that manage global finance? Then there's the concern about AI making life-altering financial decisions without understanding their human impact. An AI might decide to foreclose on a home because the mortgage is in default, following its programmed rules about risk management and contract enforcement. It's making a rational financial decision, but it doesn't understand what it means to lose your home, to have your family displaced, to lose the stability and sense of belonging that home provides. It doesn't feel the human cost of its decision. A human making that same decision would, hopefully, feel some discomfort, some moral weight. They'd recognize they're causing harm, even if they believe it's necessary or justified. That moral discomfort serves an important function. It makes us hesitate, reconsider, look for alternatives, ensure we've exhausted other options before taking actions with serious consequences. AI doesn't experience that moral discomfort. It executes its programming without hesitation, without doubt, without the moral friction that makes humans somewhat reluctant to harm others.